Hey traders, Jason here from Leavitt Brothers. Most of you know me as a pure technician. I analyze and make all decisions based on the charts. Okay, that's it. Just the chart, a few moving averages, and a couple indicators when appropriate. This has kept me on the right side of all major and minor trends for many, many years. But today I'm going to talk about a handful of economic indicators. But before you dismiss the video and exit out because I don't know much about economic numbers, I'll assure you that what I'm going to talk about is still relevant because I won't be discussing the raw data, but instead I'll be looking at charts of the data. Okay, it turns out that there are many noticeable trends that develop before recessions begin. So let's check out the indicators, let's check out the numbers, and see where we currently stand. All right, so here is continued claims, okay? And you see what we have here, we have a chart of continued claims, and then these gray boxes, these gray vertical boxes are recessions that we've had. I'm not going to go through the entire chart, as is going to be the case with the future charts I show. I'm just going to point out a few things. You can pause the video, you can recreate the charts if you want to get a better idea. Okay, so just kind of going to the middle of the chart here to late 80s, early 90s, notice continuing claims moved up, and then we got a recession. Up in 2000, 2001, moved up, and then we got a recession. Moving into like 2008, 2009, continuing claims. It wasn't a big move up, but they did start to trend up for a while, and then we got a recession. So looking right now, and the data is accurate up until 2 weeks ago. I don't have the last 2 weeks worth of data, but you can see that we don't even have a curl up yet. Okay, so if it's normal for the continuing claims to start to move up for, at least a couple months before we get a recession, we could kind of conclude that we're probably not there yet. That if a recession's in the pipeline, it's probably not going to happen until at least the middle of next year. Okay, here is the 4-week moving average of initial claims. Okay, similar situation. Going to the middle of the chart, we have, get a pointer here. So we have initial claims move up, then we have a recession. We have initial claims move up, then a recession. In 2007, 2008, I would say they just simply went flat. And then we got a recession. So again, we tend to get a move up. Okay, it's not perfect, doesn't happen every time, but we tend to get a move up in initial jobless claims before a recession forms. And since the initial claims are still trending down, you can kind of get the sense that a recession is probably not imminent. Okay, maybe one's on the horizon for next year. It's entirely possible, but it doesn't show up in the data yet. Next chart is total non-farm payrolls. Okay, we get a move down, then a recession, a move down, then a recession. Coming back here, we have moved down, then a recession. Over here, we have moved down, then a recession. Okay, it doesn't happen every time, because here's an example of a time where non-farm payrolls moved down, but we didn't get a recession. But many more times than not, you get a move down and then a recession. And a better way to state it is that all recessions tend to be preceded, or at least most recessions tend to be preceded by a move down. And as of right now, we've been sideways for a couple of years, but we don't have a move down. So if we get one of these things over the next couple months, then we're probably looking at a recession next year. But it just hasn't happened quite yet. Okay, here is the housing market index. And similar to the other indicators that I just showed you, we get a move down and then a recession in blue. We get a move down. This is 2000, 2001, and then a recession. We get a move down here. This is early 90s, and then a recession. So if that's the case, if the housing market index tends to trend down before we get a recession, you could say, hey, maybe we're in the beginning stages of something, okay? Because it topped out at the beginning of 2018. And we've basically been moving down since. If you look closely, we tend to get, there tends to be a gap, not a gap, but a lag where we get a move down for a year, 2 years, sometimes even a little bit longer before the recession actually hits. Okay, so maybe we get something like this, where this continues to move down and then we get a recession like maybe later next year. It's possible, but that's what I see. This one is kind of showing beginning signs of it, but there's certainly no guarantee. Next chart, capacity utilization. Similar to the others, I'll look at the middle of the chart here. Move down, then a recession. Move down, then a recession. This one was an exception, moved up, and then we got a recession. We got to move down here, but with no recession. Over here we got one. This one happened high. So this indicator is actually kind of mixed. Okay, sometimes a move down leads to a recession, sometimes it doesn't. Something to look out for. Right now we have a lower high, and we'll see what happens. Okay, maybe it curls down, maybe it hints at something, maybe it doesn't. As I said, the data on this indicator is somewhat mixed. All right, next one, corporate profits, with some adjustments made. Okay, move down, then a recession, move down, then a recession. Here we got flat trading, not flat trading, but flat number. Here we got a move down if you look closely. Can't really read these over here because the data is too squished. But again, more times than not, you get a move down in corporate profits before recession hits. And right now we have corporate profits at pretty much at a new high. Now the data here only goes until the middle of this year, so it's only accurate until it's not only accurate, but this data point over here is July 1st. Okay, so we don't have the last couple months of data. But if indeed you get a couple months of downward movement before you get a recession, then even if this thing rolled over, we probably still have some time left before a recession starts. Okay, this is another indicator that tells us that a recession probably isn't looming, right now. Delinquency rates. Okay, it would make sense that delinquency rates would move up before we hit a recession. Here's the late 80s; they moved up for a little while, and then we got a recession. 2000, they moved up. 2007, 2008, they moved up, and as of right now, they're actually trending down. They're not even moving up at all. Side note of this is that this data point here is July 1st. Okay, so we don't have the last couple months. When the new data comes out, we'll see what happens. But even so, since there tends to be a lag between when it starts to move up and when a recession actually hits, even if this started to move up right now, you could probably say like, hey, we're probably not going to go into recession yet, maybe not until the middle of next year. Okay, that's like, even so if it moved up right now, we're still talking like middle of next year before we actually officially went into a recession. All right, related to delinquency rates is household debt. You see household debt. Scratch that. Okay, so it would make sense. This is household debt as a percentage of disposable income. So it talks about how easy it is for people to make debt payments. It would make sense that this indicator would move up, or at least be at a high level before we moved into a recession. So you can see here in 2000, it moved up, then we went into recession. In 2008, moved 6, 7, 8 moved up, and then we moved into recession. Over here it was moving down, but it was at an elevated level. Right now it's really low, okay, which tells me that our ability to pay our debt is actually pretty good. Okay, we either have low debt levels while we're making decent money, or we have high debt levels but we're making more money. Whatever the case, our ability to service the debt is actually pretty good. So this is not hinting at anything. So again, if indeed you need this to like ramp up a little bit before we hit a recession, like even if this thing curled up, you're still looking at a recession, months away. Certainly not anything in the near term. Leading index for the U.S. You tend to get move down recession, move down recession, move down recession. Okay. The 1% level tends to be pretty magic. So if I were to, and I'm making a mess of this chart, but if I were to like draw points where it dropped below 1%, that's where we tended to get into some trouble. So look for a move down here below 1%, and given that we're already kind of trending down, so trending down plus going below 1% would probably be meaningful. But right now we seem to be doing pretty fine. Next chart, non-financial corporate sector unit profits. Okay, again, down, then recession, down, then recession, down, then recession. Okay, we had an exception here, but here we had down and then a recession. Here we had a little move down and then a recession, down and then a recession. So a lot more times than not, we had this indicator move down and then we had a recession a couple months later. We have that going on right now. Okay, so this is probably, of all the indicators I've shown so far, this is probably the most bearish one. It's been moving down for a while. And it would support somebody's claim that a recession is looming. Next chart, heavy truck sales. Heavy truck sales tend to top out before we have recessions. Okay, so heavy truck sales drop, then a recession. Heavy truck sales drop, then a recession. Heavy truck sales drop, then a recession. Okay, it's happened over and over. I mean, even from a high level, drop here, continued drop there. Okay, but as of October 1st, 2 months ago, heavy truck sales were near their high. Okay, not the high, but near a high. So if we're going to have a recession, you'd think, this thing's going to roll over and go, move down a little bit, and then we go into recession. So since this chart isn't really hinting at that, even if it did start rolling over, we're probably not looking at a recession until the middle of the next year. All right, so if I were to assess the odds of a recession right now, I'd say they're pretty low. Okay, some of these charts suggest a recession could be looming, while most of them don't hint at a recession at all. If I were to put an asterisk on here, it would be the definition of a recession. A recession is defined as a drop in GDP for 2 consecutive quarters. So we don't actually find out where we're in a recession until kind of after it happens, because we have to wait 2 entire quarters in order to find out, oh, by the way, we're in a recession. The other side note is that the market is incredibly good at sniffing out recessions. Theoretically, if a recession were to begin in the middle of next year, the market is very likely to move down months in advance and start pricing it in. So when you see some of these charts reverse, such as the heavy truck sales or initial jobless claims, you can think in terms of, hey, a recession is probably 3 to 6 months out. Okay, and then the market is probably going to start pricing it in. But in the end, just stick with the charts and the breadth indicators. They will accurately guide you, okay? Because the charts are the only thing that actually will pay you money and take money from you, not these charts. Okay, they act as a little bit of a big picture guide, but you still got to make your decisions based on the actual price charts. All right, thanks for listening. If you like the video and want me to do more, give it a like and share it with your trading friends. You can also subscribe to the channel right here on YouTube. All right, see you next time.